Should you be concerned that technology stocks continue to party like it's 1999? And while today may seem similar to the tech bubble of the year 2000, it's not the same. However, the outcomes might be. For the longer term investors, even if we are experiencing another tech bubble, all we need to do is navigate our way through it. True, that's easier said than done. However, we just experienced a crash and the fastest rebound in the markets since about 1938. But this all happened at a time when the economy shows near depression conditions. For example, we are showing negative 34.7% annualized GDP growth. We have 50 million unemployed. We have a negative 4.2% personal income. We had a huge decrease in international transactions and international trade of goods and services. Next quarter will be worse. We have a 30% decline in corporate profits, and we have a 35% decline in corporate earnings based on current estimates. There is no precedent for such a stock market and economy. Yes, this is the fastest recovery in the market since about 1938, just not so much of a recovery for the economy. This does not mean the stock market is going to crash immediately, but reversion to the mean is coming. It's inevitable, and it's the nature of cycles. The only question is timing. Remain fully invested, but make sure you understand the risks. If the stock market rises, terrific, we all made money. However, that is not how I see my purpose. The way I see it, I am here to help analyze, understand, measure, and prepare for what will reduce the value of our invested capital. My goal is to help you preserve your capital, to help you avoid losing money. So let's take a look at the charts and see if we can avoid losing money. Today we're going to look at two charts beginning here with the VIX. We're looking at stockcharts.com and the symbol is $VIX as you can see in the upper left. Now the important thing here looking at the chart is that the VIX is staying at or above that 25 level. Now I've told you before on a long-term historical time frame 25 is somewhere near average. However, more recently, say in the last couple of years, it's definitely above average. The average, as you can see, say going over here to the left portion of the chart, is around 15 or under. So, in terms of relevance of recent time frames, this is definitely above average. And it's stubborn. It wants to bottom. It wants to set a base here. And it's trying oh so hard. You can see here with the MACD that we're very near that zero line, both the fast line and the slow line, and it can pop through at a moment's notice, and it sure wants to. Look up here in the upper portion of the chart, you can see the RSI as well. You can see that the RSI is staying near that midline, higher than it was back in this time frame here. So it can pop above that midline and head up into the upper portions of that RSI very easily. And you can see that in the stock market where there's been some volatility as of late. So keep your eye on the VIX. So now let's go to our next chart. So our next chart here is the 3-year weekly on the SPY, the spiders, and the close on Friday was 320.88 as you can see here. We're looking at this double top and we've been looking at that for a couple of weeks now. We need for the current market to head above that previous high, decidedly above that, not just by a smidge, but decidedly above that, and hopefully higher than this point here for me to say that we're back into a bull run. Right now, it looks to me that things are stalling out. And I've said that here for the last couple of weeks or so. We're stalling out at this level here, and it appears to me that the greatest probability is that we're starting a topping process. Let's move down here into the volume. You can see that the volume continues to decline, definitely declined this week here. Into the MAC. Now, both the fast line and the slow line are above zero. They're in nice positive territory here, but that acceleration has stagnated. You can see here in the histogram that things also have kind of stalled here. Now, we haven't started heading on down, but I think the probability says that that's the next step, hopefully within the next week or two. And I say hopefully because I'm always looking for a bargain. But if you're afraid of the market going down, then take this time to reposition your portfolio, make some changes. Moving here into the price rate of change, you can see that we topped out at that point and we're definitely turning over with that fast line heading down pretty sharply toward the slow line. Now, it can bounce off and we can sawtooth here for a while, but definitely it looks like it is rolling over. Moving on into the RSI, this is my major concern of the different oscillators, is that point up here versus the points here and here. Definitely a downward trend, and I don't like seeing that. We've talked about this top here and this one here and here. As you can see, that downward trend didn't end very well. Moving on down here into stochastics, this is just barely looking like it's turning over. Not quite yet, but as you can see, the fast line and the slow line are much more narrow here in the last few weeks or so. And so I think things are weakening. Into the Williams, you can see that we have a fish hook here, and that's not saying much, but it can definitely head back up or it can head down and out of that overbought territory below here. That is my expectation soon enough here within the next few weeks or so. Moving back up here to the price chart, one last look. In my humble opinion, I think we're stalling out here. We need to have a strong breakout above this level or the previous high for me to say that we're in the clear. And we definitely aren't, at least not yet. So keep your eye on that and keep your eye on the VIX and remain patient and prudent. And for today, that's ChewDog Charts. Thank you.